Portfolio management is the act of maximizing the return on a portfolio. This is done with trading decisions made for the marketable securities in that portfolio. A portfolio manager or a team of managers supervises the portfolio for a client. Often, the client is the collective owners of a mutual fund. The client can also be a wealthy individual who owns a large amount of marketable securities. The chosen philosophy for how to manage a portfolio will dictate whether the manager invests in high-growth companies, companies with large cash flows, international versus domestics, stocks versus bonds, etc. The mix is dependent on the client's investment needs and risk tolerance. For instance, a client with a low risk tolerance and a long-term investment horizon will invest in blue-chip stocks and low-risk bonds such as U.S. Treasury bonds. He will avoid stocks of companies in developing nations and tech startups. There are two types of portfolio management with respect to mutual funds: active and passive. Active management means that a portfolio manager actively trades securities to try to make a better return than the market, taking into account the fund's objectives and asset class limitations. Most closed-end funds are actively managed. Passive management refers to buying and selling securities so that the fund assets track an index such as the S&P 500 or the NYSE.